It
Oh,
is
thank
all
you, Amy.
yours.
Hey, Amy, this is Mel Schwartz, and welcome to our tax legislative update. Thank you all for joining us today. We are hopefully going to be, oh yes, here we go, going to be covering, actually, here we go first. Joining me today is Jim Donovan, partner and head of, I'll go ahead and tip off what he's going to be talking about. Jim is in charge of the employee retention credit practice for the firm, is the one who really can probably, if there are answers to your questions, he is the one who has them. If there are not yet answers to your questions, then that means that the Internal Revenue Service has not yet told us what they intend to do. Also joining me is Jay Heflin, who works with me here in Washington, D.C. Jay has been closely monitoring activity up on Capitol Hill as we move from the ARPA activity that was previously enacted. And we'll have some things to say to us about where we may be going in the future. Agenda, very briefly here, we do want to talk about the deferred effective date from April 15 to May 17, the deferred filing date. Obviously get into the details of what was included in the American Rescue Plan. It is not an extraordinarily tax heavy piece of legislation. Most of the money was in fact really in more direct grants from the federal government or in support through loans, but there are still some significant changes, and we want to make sure that you're up to date on that. And then finally, also do want to talk about where we may be going next, because things may be moving more rapidly than some of us at least believed might be the case in the future. Let's go ahead and talk briefly, as I think most of you have seen, that indeed the April 15 is now May 17. So if you have not yet filed your tax return and are not in line to get it done by April 15, you do indeed have some extra time. To the extent that you are caught up with your tax payments, it is very clear that no interest or penalties are going to accrue during that April 15 to May 17 period. You actually have that as an interest-free period. We do not have guidance as to what's going to happen if, for instance, you were underpaid on your estimated taxes, did not have enough in by January 15 in order to safety yourself. If that is the case, it may well be that the interest penalties, they're called penalties, they're really in the nature of interest, may well continue to accrue between April 15 and May 17. So if you are in a situation where you are needing to rely on estimated taxes, I would take a hard look at that. And speaking of estimated taxes, the deferral of the May 17 is really a deferral of filing date for 2020. It does not delay any need to deposit estimated taxes for the first quarter of 2021. Those are still going to be due on April 15. So if you need to raise some funds for that, don't hesitate too long. Also, a number of you in Texas, Oklahoma, and Louisiana have already been given until June 15 to make your filings. This change does not affect that. You are still at June 15. There is no intention on the part of the IRS here to roll you back to May 17. So for taxpayers in those states, keep on keeping on, and that's it. The other current event, recent activities that has come up really falls in the employee retention credit area. And because there is also some significant change with respect to the IRC in the American Rescue Plan Act, I'm going to turn things over to Jim Donovan right now and let him lead us through this very important and hopefully very profitable
Thank you, Mel. I appreciate it. And thanks to everyone who's here today. Oops, and I went too far, too fast. Appreciate you guys joining. We're going to talk about the employee retention credit yet again, because it's been enhanced and expanded yet again, which ERC is the gift that just keeps on giving, right? And the ARPA shared a few new wrinkles, so we'll go over that today too. And so with that, what we do have now are really three sets of law. We had the CARES Act for 2020. We had the CAA in December, which extended the ERC through Q1 and Q2. And now we have the ARPA that gives us Q3 and Q4 for the ERC. So what I've done here is just kind of outlined, kind of the different time periods we have in play, right? The different credit rates. So again, in 2020, it was a 50% credit rate. For 2021, now we get a 70% credit rate. So it's a significantly better benefit. The other difference is, while it's still the same max 10K per employee, for 2020, it was really over that 9+ month period. And then we get to qualify up to 10K per employee on a quarterly basis in 21. So again, that maximum credit 5K in 2020, again, over that basically that 9-month plus period. And then on a quarterly basis, 7K. So it's a significantly more lucrative deal under the CAA and the ARPA for the ERC in 2021. The other difference here is the eligible small employer. Again, if it's 100 employees or less in 2020, you can take the ERC on everybody. If it's over that, you can only take the ERC on employees who are being paid but not providing services. And then for 21, that jumps up to 500 employees. So man, if you're in that bracket of, gosh, full-time employees, less than 500, this credit could be in the millions for those taxpayers that don't exceed that 500 full-time employee number. So again, a significant benefit. All right. Some of the other differences here is the gross receipts decline to qualify for the credit. Again, there's two ways to qualify. There's a gross receipts definition, which is really that bright line test, greater than 50%. Decline in 2020 versus 2019 is how you're going to qualify for 2020. Again, under that bright line test. They reduced it under the CAA and ARPA to just a greater than 20% decline in gross receipts. Calendar quarter over 2019, the last normal year. So again, easier to qualify for the credit. The suspension of operations test applies equally for both periods. We also have the look back provision, which isn't applicable for 2020, but is in place for 2021. Again, this allows you to look back a quarter that says, hey, you know what, if you don't qualify under the current quarter, would you have qualified under the previous quarter? And if so, you can qualify. The other thing that's in here is government instrumentalities. Again, under the CARES Act, certainly didn't qualify for ERC. We have an expansion under the CAA and ARPA, where we have public colleges, universities, organizations who provide medical care or hospital care, and then certain federal instrumentalities like credit unions can qualify for the credit in 2021. All right. Some new wrinkles under the ARPA, this recovery startup business, and then the severely financially distressed employer. Try saying that 5 times fast. These are some new wrinkles in the ARPA. So really the recovery startup business is a new category of eligible employer. And basically, if you have a business that started after February 15th of 2020, you basically don't have to meet a gross receipts test. You don't have to meet a suspension of operations test. You qualify for the employee retention credit if your total gross receipts were less than $1 million. You are limited to up to $50,000 in credit per quarter. And again, that's still going to be based on wages paid to individuals. But again, if you're a brand new business, gosh, this is kind of a free 50K each quarter. So, and again, only Q3 and Q4, but again, a pretty nice benefit here. The other one, the severely financially distressed employer. In this case, if you have gross receipts that are down over 90%, so man, you took a huge hit, And this quality, again, we're looking at Q3 and Q4 of 2020, or sorry, 2021. Basically what this rule allows you to do is if you're over that 500 employee threshold where you'd only be able to take the credit on employees who are, being paid but not providing services, in this case, you can take the ERC on everybody. So that's the big bonus here. If you're severely financially distressed, your credit could be just huge. So again, nice benefit here. Just last thing I'll cover is, overlapping provisions, right? With CARES Act, we can't double dip with PPP, FFCRA, WOTC, FMLA. The list keeps growing as you add or as these laws continue to come out. So you add Indian employment credits, veterans credits, R&D with the CAA, and then the ARPA. Of course, they added the shuttered venue operator grants, restaurant revitalization grants, along with all the other stuff. So again, more hurdles or limitations on double counting wages. All right. So the other thing I talked about is we finally got guidance, right? For close to a year now, you guys have heard me say, gosh, we don't have guidance on this. I'd love to have something outside of the FAQs. Well, we finally got that on March 1. Now, notice 2021-20 only applies to 2020, basically that CARES Act period. But, presumably it'll be similar for 21, right? It at least provides insight with how they're going to look at it. So, largely it was a cut and paste job with the FAQs. So if you read those, you kind of have a good idea. But there are a few things that they kind of they tweaked, if you will, or provided some additional clarity around. And one is essential businesses. So you can still, of course, qualify if you're an essential business for the ERC under that gross receipts test. But if you qualify under suspension, basically they've defined more than a nominal portion of the business is suspended as 10%. And that's really based on gross receipts on a calendar quarter versus 2019, or hours of service. So if more than 10% of your hours of service are suspended due to a government order, and even though you're an essential business, you can still qualify for the credit. There are some other ways, if your suppliers are limited and can't get you materials, or your hours are reduced, you can still qualify that way as well. They give lots of examples. The other thing is if you're a non-essential business, again, you can still qualify under the gross receipts test, but they put out this comparable operations test, or things to consider if you can still continue on. And if you can effectively telework, if the work is portable, if there's no need for physical workspace and the time to transition to working from home, it's going to be tough to qualify for the ERC if you don't meet the gross receipts test. But it's a non-exhaustive list of things to consider. But if you do meet these tests, for example, need for physical workspace, they have a great example in there about a physical therapy office. You can do those meetings online, but it's not the same as actually having them in the office where you have equipment they can work on for physical therapy. They also mention a lab, right? A lot of the individuals at the organization can work from home, but the people in the lab can't do those experiments at home. So again, they would not be able to do comparable operations, and they would qualify under suspension of operations or suspension of business test, right? So that's something to note in there. Again, some great examples. The other thing that Notice 21-20 has are, and really to me, it's fairly obvious, right? But if you have employees that are working for multiple entities in a controlled group, again, it's 10,000 in the aggregate. You can't try and double count them at the different entities. And the other thing they mentioned in there is that, hey, the ERC, the credit's actually allocated across the different entities based on qualified wages that are giving rise to the credit. So it's really kind of a pro rata deal. All right. The other thing that's in Notice 21-20 are some substantiation requirements, what you should be keeping in case of an audit. And so, you guys can largely read through these, but it's the bright line stuff, right? The government orders, how would you meet more than a nominal effect, gross receipts analysis, and then basically, how did you compute your credit? And so they're asking that you keep these records for 4 years. Now, we may have to keep them for a little bit longer for Q3 and Q4, which I'll get into in a minute here. All right. So, you're probably asking, gosh, Jim, notice 21-20 sounds pretty great. And it was. It provided a lot of guidance for us. It's nice that we have something we can actually rely upon versus the FAQs we couldn't. But there's some stuff they left out. So the first item is, if you're talking about 2020, it'd be great to be able to file one 941X and claim the ERC for the entire year. Unfortunately, they don't allow that. They're still requiring you to amend your 941 for each calendar quarter that you would qualify for the ERC. So a bit of a pain in the tail there. The second thing is the 280CA add back. So, you guys probably heard me talk about this in the past. There is an add back to income, or really it's a reduction of your wage deduction in the amount of the employee retention credit on your 2020 tax return, because you can't double dip with the credit and the deduction, right? We were hoping for some guidance that said, hey, you know what, go ahead and take that into income in 2021 versus 2020. Unfortunately, we didn't receive that. Now, maybe we'll receive some future guidance, because I just can't think that the IRS wants all these amended tax returns for a small ERC add back, but that's where we stand right now. The other thing that I'll mention here that came in the ARPA is they did extend the statute of limitations to 5 years. And based on my reading of the law, that really only applies to Q3 and Q4. And we do have those two new provisions in there with the severely financially distressed employers and the recovery, the new recovery business, right? So maybe they're focused on that, but I don't know. I don't love the fact that they're extending it an additional 2 years versus the standard 3-year statute of limitations. The other thing that is out there is they are switching it in Q3 and Q4 to offset Medicare instead of Social Security tax. I think that's more for the IRS benefit. For the most part, it's a refundable credit, right? So the way we think about it is cash, or as an organization, right, you're going to get the cash back regardless of what tax it offsets. So just something to know there. That's a minor change that, I don't know, maybe bigger than what I initially think right now, but something to be aware of. The last thing that I really want to cover, and a question a lot of you guys have, is, okay, well, tell me about how ERC and PPP intersect, right? Because before it was mutually exclusive. Oops, sorry. And it is no longer mutually exclusive, right? So, with respect to PPP and ERC, initially what the CAA said is, hey, wages apply to ERC unless you elect to have them apply for PPP. And so we're like, okay, well, how do you make that election? Well, the guidance in 21-20 basically says, hey, you know what, if you put the wages on the forgiveness application, you've effectively elected to have them apply towards PPP versus ERC. So that's the easy answer there. For many borrowers, let's talk about that overlap, right? You're going to have PPP and ERC in the same period, right? So it's like, well, Jim, how do I bifurcate these costs? And effectively, we're going to have a lot of latitude on how we maximize each of the incentives, right? So, what the guidance gives us is actually a lot of flexibility in terms of how you pick up those costs. So let me flip this. All right. We don't have time to go through all these different examples today, but the notice gives us several examples. And one I'll just kind of walk through in general, right? So if you have a loan of $100,000 and you put $150,000 on your PPP forgiveness application, and let's say it's all wages, because I know a lot of you may have submitted non-payroll costs, but the bank pushed back on you and said, hey, no, just give me the wages, right? What we have here is, you needed the 100K for forgiveness, you got it. You can claw back that 50K for ERC purposes. Now, If, for example, you had $20,000 in rent expense, but you didn't put it on the application, unfortunately, we can't claw back that 20K. You know, we're essentially stuck with what's actually on the PPP application. So some good and some bad there. Again, I think we're going to have some flexibility to move wages around. You know, if you have a 24-week covered period and we really only qualify for ERC in Q2, maybe we can maximize our ERC in Q2 and push our PPP forgiveness wages into Q3 really. So again, what I recommend is that you talk to your accountant about maximizing those provisions and that overlap there. There's certainly opportunity to play to maximize those benefits. So the other thing, again, just don't double dip, right? That's the key takeaway here. Don't try and take the same wages for both. You know, one of the things that we know we can take is, you know, you have wages for individuals making over 100K, right? So we know we can take those because you can't take them for PPP. I guess the other thing I'll mention too is if your PPP loan is not forgiven, we can pull all those wages back in for ERC. So those are the highlights of the ARPA and Notice 21-20. And I know I threw a lot at you guys, but Mel only gave me 15 minutes. So I tried to squeeze in as much as I could.
Thank you, Jim. That is always I have noted that there are a number of Q&As regarding the ERC that have drifted into the box. I think rather than take the time to do that orally, I will let you address those specifically. Although one that seems to be recurring is, can you just give us a very, very quick overview of how owner employees in an S Corp, or for instance, partners, active partners in a partnership, how does their compensation fit into the ERC?
Man, we've been receiving a ton of questions on this. I will tell you, it's not black and white. You know, if you are less than a 50% owner, you have wages. We believe we can take you into the credit. If you are greater than a 50% owner, you know, and have wages, we also believe that you should be included in the credit. Now, again, it's not black and white, but that's where we're shaking out based on what the guidance provides. So that's kind of a quick overview to answer their question, but I'll type more in the Q&A.
Yeah, worth moving forward in the case of that type of taxpayer in any case. Yeah. Well, with that, let's move along to the other ARPA provisions, and we're going to start with what actually may end up being one of the most significant of those changes, and that is in the child credit. And I'm going to pass this along to Jay, who's been following this issue, and let him lead us through how this change is going to work.
All right, so most of you probably know that the American Rescue Plan extended the child tax credit. And if you don't know, fear not, because the IRS and Treasury is going to carry out a sweeping public awareness campaign to educate everybody about this credit. And basically what they're going to tout the most is that the plan increases the credit from $2,000 to $3,600 if you have a kid under 6, or $3,000 if you have a kid over 6 or 6 or over and under age 18. That's kind of a big deal because basically kids, it used to be under the age of 17, and so they've increased it up a year, which is nice. Now, this credit is now fully refundable, and so that means you don't even have to owe taxes to get it, which I'm sure you guys know that. And then the big question is, when will this money come out? Yesterday, there was a Ways and Means hearing, and at that hearing, IRS Commissioner Charles Redding was there, and he was asked, will this money come out in July when it's supposed to, and will the payments be monthly? He didn't confirm any of that. He basically said that because of the delay in the tax season, they're going to be strained to get everything together to actually get money out by July 1, but they're going to try. He also kind of hedged on monthly, because in the law it says periodic, and the House bill said monthly. The Senate changed that to periodic, and Reading yesterday really kind of honed in on the fact that this could be periodic, meaning quarterly. And so right now it's kind of an unknown exactly when this payment will start. But he did mention that there's an online portal that they're going to put together. So you can basically, instead of waiting for a check, you can actually get it through direct deposit. Now, this credit is only for 1 year, this year. There are efforts to extend it. And if they extend it, it's going to cost $1 trillion of lost federal revenue for 10 years. There are other estimates that say it could be $1.6 trillion over 10 years. So this is what's considered a really big ticket item. So those efforts may fall to the wayside, may not, but to do it, do you offset it? I don't know. That this was raised during the hearing, and no one really has any answer what they want to do, but there is clear evidence that Congress does want to extend this. And so you might want to notice efforts that they're trying to extend this into 2022. They might do it a year at a time, or who knows. But anyway, the effort is there to extend this, and it seems to be both Republican and Democrats agree to it. So that's something that's that's unusual in Congress when you have the parties agreeing on something. So lastly, the thing that I'll end on is that the phase outs for this. So currently the credit will start to gradually fade out, starting at 150 for joint filers, 112,500 for head of households, and 75,000 for joint filers. And then it slowly goes off until it's done. And then basically, I think at the end of it, when you get to the 2,000 mark, that's when the phase out for the prior year kicks in, and then it goes away after all that is done. So the takeaway from this is that this is only a credit for 1 year, but efforts are being made to extend this, and it might be an annual extension. So stay tuned.
As is always the case with Congress, stay tuned is important.
Yeah.
This is an item really that I'm not sure many people, at least with higher incomes, had focused on previously, but with the expansion or the extension of the numbers where the phase out begins, I think this is something that is something worth probably following more and more for more taxpayers. Let's move on to some of the other items in the ARPA. There continue to be some issues with regard to paid family and medical leave. Most of us, I think, focused on this as part of the Families First Act back last spring, where employers with 500 or fewer employees were required to provide paid family and medical leave, but then we're eligible for a credit that would essentially offset the full cost of that. The credit has been extended, but the mandate has not. So if you are not required, if you fall into this 500 or fewer employees category, you're not required to provide paid family and medical leave, but to the extent that you do, and you meet the requirements that were set forth when Family First came out last spring, then you are eligible for the credit. Now, as Jim pointed out frequently, and we're going to continue to point out frequently, there's no double dip. You can only use wages for one of these purposes. You cannot, if you use it for family and medical leave, you can't use it for PPP, you can't use it for ERC, you can't use it for WOTC, you can't use it for, you can only use it once. Just keep that in mind. And the rules are still a little bit in flux as to how much freedom you have for allocating it back and forth. Stay tuned with respect to that. But if, again, you are an employer with 500 or fewer, you can, and you satisfy the family first requirements. And notably, this has now been extended for wages paid through September 30th this year, and you get a fresh start on the amounts. You are not, if you paid up the maximum that would be eligible for the credit under Families First, we do get a fresh start if, again, paid wages are being paid. Now, other employers, those of you who do not meet the 500 or fewer employees test, not eligible for the paid family and for the normal credit, you continue to be eligible for the 45S credit, which has been in the code for a while. It is nowhere near as generous as the Families First credit, and the amount of the credit you get is somewhat dependent upon what percentage of the normal pay that you make when the employee is out. And unlike the Families First credit, which was technically a credit against employment taxes, fully refundable to the extent you had more credit than you had employment taxes, this is 45S is a general business credit. It goes against the income tax. It's subject to all of the limitations that apply there. But notably, at the end of last year, it was 45S was part of the extenders. So this is effective for wages paid through 2025. So if we do not see a further extension of the Families First type credit after September 30th this year, 45S is where all of us are going to have to be looking for that benefit. Not to dwell on this, there's been an enormous amount of coverage for the additional $1,400 of recovery rebates. Keep in mind that the IRS calculated this number, or the size of your rebate at the time, well, using the latest filed return they had at the time they determined the payment. Now, if for some reason that results in a smaller check than would be the case if you applied your 2021 numbers, then you can claim a credit on your 2021 return, not before. If for some reason 2021 would have yielded a smaller rebate, then this was, after all, a stimulus payment. You don't have to pay back the deficiency, you get to keep it. Notably, I think most rebates have already been paid, or at least are in the process of being paid. I know a number of banks have already credited to their customers' accounts. So we're probably beyond a place where there is a planning opportunity here, but it is one to keep an eye on, particularly if there was some reason that you were limited in the amount of the check that you received, because after all, it did phase out and phased out pretty quickly. But if you were close to that margin and can manage your 2021 return, it is something that you might want to take a look at for there. Other big news was the exclusion of unemployment compensation from the 2020 return. Essentially, the first $10,200 of unemployment benefits from 2020 could be excluded, and that is $10,200 per worker. So if you have married filing joint, both spouses worked, both spouses were laid off, both spouses collected unemployment, each one separately may calculate up to $10,200. Now, what it does not appear separate calculation applies to, though, is the phase out. And actually, let's not say the phase out. This one is a cliff. If your AGI, or it's actually a modified AGI, goes over is $150,000 or more, then you don't get the exclusion at all. And that's the case. If you've already filed your 2020 return, reporting this as income, Certainly, you are free to file at this point, it would still be a superseding return because we've not gotten to the new May 17 due date. But there is also some indication that the IRS may be considering a simplified method so that you do not need to file the entire return. I will leave it up to each individual taxpayer as to whether they want to go ahead and be proactive or whether they want to wait a little while and see if the service will come up with a simplified method. A few other items to make note of. There are, the Small Business Association has special EIDL loans. These were continued in the legislation that was passed at the end of last year. And also we now have the so-called restaurant revitalization grants. The new legislation makes clear that these are excluded from income, do not result in disallowed deductions, and to the extent these are occurring within a partnership or S corporation, they are to be treated as tax exempt income and thus will increase the owner's equity in that entity. One of the revenue raisers that slipped in changes the third-party settlement rules with regard to reporting. Previously, a third-party settlement entity, which is one that really clears the transactions on a credit card. So long as this was a de minimis activity, and that was defined as $20,000 of clearance or 200 transactions, then they were not required to file the reporting forms. That has been blown up completely. And in a minute, de minimis is now reduced to $600. If you or your company have any involvement with regard to this, please do check because we suddenly have very, very different reporting requirements that may not have applied before because it was such a small part of the operation that now will need to be taken into account. Finally, student loan defaults for taxable years 2021 through 2025 are not to be included in gross. They are now an exclusion from gross income. And again, they are not intended to offset basis or other items. It is, I think, here worth noting that this is sort of a baby step toward what is going to be a legislative initiative to actually forgive some of the student loans. That probably will have to be limited to situations where the government was involved with the student loan and not to true private student loans. However, this provision here from ARPA that keeps a default from being treated as relief of indebtedness income is going to apply to any student loan for post-secondary purposes. A few things here for the future to keep in mind. These were the revenue raisers. They are revenue raisers that are not scheduled to occur for quite a while. It's, I think, worth noting them, but it is just worth noting them because lots of time is going to pass before either we get an extension of the 461L limitation on non-corporate taxpayers taking losses, or the expansion of the $1 million limitation on salaries that are paid to publicly traded companies. I think we're going to, if we can, Amy, let's go ahead and move along to what comes next. And with that, I'm going to turn things back over to Jay Heflin, who is going to talk about where our political landscape is today and maybe even tomorrow. Jay?
Maybe even September. So the Build Back Better, it's been heavily reported. This plan is now coming forward. This bill is expected to include infrastructure, climate change, healthcare, and possibly an extension of the child tax credit.
Let me break in for a second. Amy, can you advance the slide one? I'm not getting anything here.
Sure thing. Try again. There you go.
There we go. Okay, thank you, Jay.
All
I
right.
apologize for the
No
interruption.
problem, Mel. So as it shows, this cost is between $2 and $4 trillion. That is an extremely large bill. The federal government spends basically $4 trillion in a year. So this is a bill that would equal the cost of federal spending for a year. There are going to be two committees that are going to be working on this bill, and they are the Transportation and Infrastructure Committee and the Ways and Means Committee, which is the tax writing committee. The Transportation and Infrastructure Committee will come up with the provisions, with the infrastructure provisions, the healthcare provisions, all that stuff. Ways and Means Committee is going to figure out how to pay for at least part of it. And so what they're thinking is that they might be able to offset at least between $500 billion and $2 trillion of the bill's cost. The rest would go onto the debt. And so the vetting process for this bill is going to start next week. The Ways and Means Committee is on March 23rd is going to hold a members hearing. And what this hearing will entail, well, that members, a part of the committee and outside the committee, are going to testify, and they're going to say, I think this bill should be in this bill. I think this provision should be in this bill. And they just basically go on and on and on and talk about it. There's really no discussion. They just do their sales pitch and then they leave. Some of the tax increases that are expected to be brought up at this hearing is raising the corporate income tax rate to 28%, rescinding the tax cuts from the 2017 tax reform bill for people making over $400,000. I'm sorry, joint filers making over $400,000. So this isn't an individual making $400,000. This is a couple making $400,000. And they might be asking to return the top individual rate to 39.6. Raising the estate tax to 45% might be brought up, and maybe lowering the exemption to 3.5 million. They also might be talking about taxing capital gains at ordinary income rates for millionaires. And a big one, this is maybe bigger than the others, create a miles traveled tax. So instead of a gas tax, you would have miles traveled. And the reason for this is because cars are getting really efficient and the electric vehicles are coming into play. And so the gas tax doesn't raise the money that it used to. And so now what they're trying to do is figure out a different way to do that. And this is the miles traveled tax. It will get the same pushback because anyone who drives their car is going to have to pay this and they're not going to like it. But it could really be a huge money, and it might actually offset the pairing of some of these other tax increases. But also, there's going to be, well, they want to include a tax cut for middle-class people, and that would be couples earning less than $110,000 a year. What that tax cut would be, I don't know. It's really early, but there is a sense with the people that I talk with that if all they're doing is raising taxes and building bridges, no one's going to see a benefit from this bill like they did in the first bill, where they get money coming into their account tax-free. So they're trying to figure out a way to entice support from this, because these are projects that people aren't going to feel. And so they're trying to get a way to get some sort of support for this. And so this middle-class tax cut is one of the things that they're going to do. So the Ways and Means is going to have their hearing on March 23rd. The Transportation and Infrastructure Committee is going to have its member hearing on April 14th. That's when we're going to hear, I think we should be building bridges. I think we should have healthcare. I think we should be doing something with climate change. And those provisions are going to be raised during that hearing. Now, this bill is not going to happen overnight. It's going to take several weeks, if not months, to actually create. I have talked to people that think a vote on this bill will be in September. Some people say maybe if they get lucky, it could be July, but no one really knows, because this is such a huge bill, and they might actually have to break it up into pieces, because there's a rule called budget reconciliation, which basically allows a bill to go through the Senate and pass with a simple majority. Normally it would take 60 votes. Under reconciliation, it takes 51 votes. And what that means is that they might want to try to use the reconciliation for things that won't pass the Senate with 60 votes, i.e. those are the tax increases. And so what might happen is that they might break this bill into two parts, and the reconciliation would include the tax increases, which only takes a simple majority to pass, and then it's law. And then the other bill would be all of the infrastructure projects, all that kind of stuff. Now, senators, the Senate is where this has to happen to get 60 for this other bill. Well, there's a thing called earmarks, and I hope I'm not too in the weeds on this, but there's a thing called earmarks to where they can designate spending for a particular district or state that benefits the lawmaker, to say, hey, yes, I voted for this bill because we're now building a bridge in our town and all these people are being employed. And so if they break the bill together and they have the tax increase bill go through reconciliation, Republicans don't have to vote for that. They then can support the other bill that has the spending things and the earmarks in it and say, look, no, I supported that bill, not the tax increase bill. And so it actually is a good plan. We'll see if it works. But the earmark thing just came about again this year, and it could be a game changer for actually passing legislation, but with both parties supporting it. That's all I've got. So Mel, back to you.
Yeah, okay. Well, that describes, I think we have to admit, Jay's given us a very good overview of where certainly the Biden administration would like to take this. This is an incredibly heavy lift that Jay has just described. A number of factors, I think, will play into to a difficulty there. Certainly, and let's go back here. He mentioned the idea of making some of the things from 2021 permanent, back when he talked particularly the child credit. That, as Jay pointed out, is likely to be, if you do the full 10 years, is $1 trillion all by itself. Certainly, as we move into looking at environment, there are likely to be additional, let's say, new and potentially more generous environmental incentives. We certainly know that such things as offshore wind, maybe even expansion of current solar and other types of alternative energy projects are going to be on the table. And a significant part of the Biden campaign was that his position that the previous administration had not been successful, or at least as successful as they had hoped to be, in encouraging domestic production and the repatriation of economics. And so we might be seeing that. So each one of these, I mean, maybe the other two don't cost the $1 trillion that Jay mentioned, but are certainly something that are going to add to the cost of the total bill. And that means that there will be even more pressure on the so-called raisers. Now, this is a list. Jay mentioned these, particularly the corporate rate increase to 28% is clearly going to be on the table, but I think the open question there would be, if the tax legislation were to be successful, how quickly would we be going to 28%? And let's loop down to the idea that that also involves a question of how are we going to approach international activities? We know with Janet Yellen having come in as Secretary of the Treasury, we're going to have a much more cooperative, maybe cooperative is not the right word, but there's going to be a greater interest in coordinating our activities with the activities of other countries, with sort of this general idea that maybe over the past decade or so, there has been a race to the bottom with respect to corporate rates. And I mean, clearly the original initiative to get the corporate rate down to where it is today was in large part a recognition of the fact that US multinationals could not effectively compete against other countries' multinationals because of our higher rate, and that it needed to come down, and that 21% is where it landed. Now, notably, Biden has never talked about increasing it all the way back to where it was prior to 2017. And even in the context of the 28%, I think we may be looking at a slower rise, but if there is going to be future tax legislation, I think Jay's right. This is one that is going to have to be on the table. We're going to have to, we'll see how quickly it gets back up to a number that looks like 28%. If 28% is 10 years out, then I'm not sure that the, I mean, I think they can continue to use the 28% number. But it's going to be interesting to see how this interacts with any changes on the international side. But on a more immediate note, the idea of restricting the use of benefits to taxpayers, married filing joint taxpayers that have more than $400,000 of adjusted gross income is one I think that we may need to pay much more attention on the business side. That could go to the question of whether the pass-through deduction would continue to be available to those sorts of taxpayers. And when you look at really anything else that might go into itemized deductions, that might go into other benefits, any of those may well be fair game. Fair game's the wrong term. Any of those may be a target with respect to this idea that tax benefits are going to at least be phased out for higher income. And that's going to become particularly a concern with respect to any attempt that is going to add an additional so-called middle class benefit to families that are earning, that have an AGI of less than, what, Jay, did you say was 120,000, 125,000?
110.
110.
Yeah. So people
Well,
making 55, the thought is that people making $55,000 a year, a couple making each $55,000 a year, that's what they're putting it at. And that's basically the median income of the country.
okay, if that's the median income of the country, that's saying that half of the country would be covered by that.
Yeah. Well,
Now, it's going to be hard, and if we're focused on taking away deductions of those above 400,000, that's a lot less than half of the country is in that description. So the ability to provide really noticeable benefits to the under 110 group without, again, absolutely rubbing the numbers off of the federal credit card is in that puts additional pressure on doing more that would raise the taxes of the over 400 group.
yeah, there's a group called the Joint Committee on Taxation, which Mel is a part of. They come out with a document that shows the breakdown of how many tax returns are filed for certain incomes. Well, over 200,000, this is a couple of years ago, but people who had over $200,000 worth of income, there were something like 9 million tax returns filed. So that's $200,000 and up. And when you look at where all the other tax returns are filed, like look at 40,000, look at 80,000. And it's really kind of striking that when you think that these tax increases are going to be on people making over 400,000, that's less than 8 million or 9 million tax returns. And so it does become an idea of how much money comes out of these people's pockets. And so it'll be interesting to see how that argument unfolds on Capitol Hill when this happens, because the argument's going to happen, but I don't know how it's going to be resolved.
Right. It is easy to, and I think where we really want to sum this up is it is easy to listen to the list, is to listen to what kind of hearings we're going to have, what this strategy that might be followed. This is, again, a hugely heavy lift for a number of different reasons, not the least of which is one Democratic senator says, no, I'm not going to go along with it, and the legislation doesn't pass. So yes, it's important, I think, to be aware that these things are out here, but I would urge holding off in assuming that any of this is going to be enacted on the kind of schedule that perhaps the Democratic administration would like to see. Could happen. You're certainly going to see a lot of stuff in the paper, and that includes some of these other items, such as the changes for very large estates. Keep in mind that that probably is 1 million and up when we define a large estate and the so-called death tax. But we are a ways away from this actually being enacted. There will be strong push to make anything that is enacted either phased in or at least a prospective change. And with respect to that, I would, the sort of the basic issue is don't panic and keep tuned, and maybe we'll have a little bit more to report the next time we all get together. All of our emails are there, and you are welcome to email any of us at any time with respect to questions that you have.